Alrighty.
And we are back for another live episode of Coffee with Bob. It's great to be here.
Great day.
Thanks everybody for joining us over your morning cup of coffee, whether it's your first one or your fifth one, no judgment. Bob, you're drinking out of an artifact, sort of.
This is an old one.
Yeah, that's like from the 90s, but I am drinking out of our brand new Coffee with Bob coffee mugs. And we also have some Coffee with Bob private label coffee called Bob's Brew. It's a Brazilian blend, excuse me. Ooh. So if you guys would like to enjoy future Coffee with Bob episodes with your own Coffee with Bob private label coffee, let me know. Give us a call and we're happy to send some and a few mugs your way. We're really excited to bring this episode to you guys today. Tax efficient investment strategies. It's timely for sure.
Very timely.
Before we dive into these investment strategies, I want to make sure you guys know we have a YouTube channel. Search Hapanowitz and Associates on YouTube, and you can watch all past episodes of Coffee with Bob, but any future episodes of Coffee with Bob as well if you're not able to tune in live. And hit subscribe as well. That's how you'll make sure that you're up to date with the most recent content that we're putting out there. Good stuff on there, so definitely check it out. So let's dive into it.
Yep.
Bob, talk to me about the importance of tax efficiency when it comes to managing money.
Well, when you think about drags on portfolio rates of returns, taxes are right up there at the top because eventually the piper has to be paid. What you can do is minimize taxes and control when you pay taxes when it's right for you to pay taxes.
You know, just like many other facets of what we do, what we're going to be talking about today, there's a lot of overlap when it comes to estate planning and income tax planning as well. So what we've done is highlighted 15 tax efficient investment strategies. Some of these may interest you. Some of these may make sense for you. If you think they do, work with your advisor, give us a call. But also, I wouldn't be surprised if those conversations also turn into conversations with your estate planning attorney and with your CPA as well. So let's talk about these 15 strategies.
Let's do it.
Okay. Number one, diversify your account types. Talk to me about this.
So typically when we work with a client, they'll have an individual account or a joint account with their wife or husband, and then they probably have an IRA account, right? Because they worked and they have a rollover from their 401k or pension plan into an IRA. Well, perhaps a third account might be appropriate, might be a Roth, Roth conversion from an IRA to a Roth IRA. And there can be some tax benefits of tax-free growth and tax-free distributions after a period of time. So that's one kind of thing that your advisor can help you with.
Yeah, income from different types of accounts is treated differently in terms of taxes.
Yep.
So when we talk about diversification as advisors, a lot of the time what we're talking about is diversification between stocks and bonds and within the stock and bond portions of your portfolio. But this is another type of diversification that we like to focus on. And when you diversify yourself from a tax standpoint, that can potentially down the road lead to really good things when you're taking income from that portfolio. Okay. Second, put the right types of investments in the right types of accounts. What does that mean?
Well, that means put tax efficient investments in taxable accounts and non-tax efficient investments like funds that trade very quickly. They might go into IRA accounts.
Okay. So it's definitely it's a global strategy when you're implementing certain investments into certain types of accounts. Okay. Number three, hold on to investments for at least once a year.
So
for at least 1 year.
Yeah, for at least. So the caveat there is always make a good economic decision first and foremost. If it happens that you can kick the can past 365 days and get 1 year treatment, currently the tax laws for everybody, long-term capital gains are treated with more favorable tax treatment than short-term capital gains. So that's the idea here.
Short-term capital gains are treated as ordinary income.
Ordinary income.
Okay. Number four, use or recognize losses to offset your gains.
So under current tax law, you can carry forward tax losses indefinitely to future years. So you get to pick when you want to use those tax losses to offset certain gains. For example, if you have a year where you know you're going to have short-term capital gains, which are taxed at higher rates, you might want to use the losses at that year rather than to offset long-term capital gains, which are taxed much more favorably.
Okay. Number 5, use Roth IRAs or Roth 401ks to your advantage.
So young people should always be using a Roth IRA 401k. They have a lot of time to pass that sort of tax payment delta where it makes a ton of sense to have all this tax-free growth and tax-free distributions from Roths. And then when you think of Roth IRAs, it could also be a very good estate planning strategy for people who are a little bit older and want to do some planning for the next generation, or maybe even for their own distributions in retirement accounts.
Yeah, absolutely. When it comes to whether or not you should be contributing to a Roth or converting some of your traditional IRA to Roth IRA, we really encourage you to talk with your advisor, pull in your CPA, pull in your estate planning attorney if necessary, because there are multiple factors that play into a Roth contribution or conversion making sense in the long term. So definitely reach out to your advisor if that's something that might interest you. Okay, number 6, ETFs versus mutual funds. So why don't you first explain what ETFs are compared to mutual funds?
Yep. So an ETF looks a lot like a mutual fund. Couple differences. One is they trade on the exchanges every minute, every second of the day. So you have instant liquidity. But the big feature with exchange traded funds, ETFs, is that they have tax efficiency built in, so that unlike traditional mutual funds that pay out distributions whether you want them or not at the end of the year, the exchange traded funds tend to keep those distributions on board. And so that way you control when you're going to pay taxes, because you control when you're going to sell a portion or all of that exchange traded fund and recognize those taxes. So you can plan for those. So
having that extra level of control through ETFs, that could really especially make a difference in a non-tax sheltered account versus a retirement account, right?
Correct.
Okay. Number 7, municipal bonds.
So muni bonds, usually you think of somebody who's in a higher income tax bracket that might use municipal bonds in their portfolio, because municipal bonds pay tax exempt interest at the federal level and sometimes at the state level. And generally, when you think of muni bonds, they're usually pretty safe. In other words, they have very high credit rating. So muni bonds would be a replacement for corporate bonds or treasuries in the taxable portion of somebody's portfolio.
Okay. Number 8, 31-day buyback strategy.
So this usually comes into play when you're thinking of somebody who took a tax loss and they want to buy back the security. What we would advise them to do, if they sold Merck, maybe buy Pfizer instead, or double up on the Merck shares and then wait 31 days and sell the original shares of Merck, and that way the tax loss is recognized. You'll be able to use it to offset gains.
And that's just an example, but the point we're making here is if you're selling something at a loss to potentially use those losses to offset gains, it's important to do it in a way where the IRS will not
make you recapture
those losses. Exactly. So 30 days is that holding period required for that. Okay. Number 9, gifting stock.
So if you're charitably inclined, gifting stock can be a great way to avoid capital gains. And whether it's short-term gains or long-term gains, all you got to do is make a gift to your favorite charity, whether it's a church or the food bank or whoever it might be. And that way you get the benefit of making that gift, which makes you feel great. You're benefiting somebody who's in need, and you get a tax break for doing that too. So you get to use that gift, the value of that gift, as a tax deduction on your return.
Okay, so this next one is another great strategy, could be a great strategy for individuals who are charitably inclined.
Absolutely. It's always nice to be charitably inclined. And if you have a large IRA account, maybe you're taking a required minimum distribution, well, you can make a contribution to your favorite charity if it's a 501c3. Directly from your IRA. You avoid the taxes associated because you get a tax deduction for making it, and it offsets the taxes that you would have paid
on the distribution from the IRA. Now, that is subject to maximum amounts of qualified charitable distribution. So make sure you talk with your advisor, talk with your CPA if you're thinking about doing this.
Yes.
Okay. Number 11, step up in basis at transition of wealth.
So this is likely to go away this year under the Biden tax plan that he's been telegraphing. This is one of the things that is likely to go away, along with higher rates and along with long-term capital gain, favorable tax treatment. That's likely to go away for higher wage earners. But the step up in basis at transition to transition wealth is likely to go away at the end of this year. I think that's what's being telegraphed to us. And essentially, if you die and you pass on the stock to the next generation, they get to sell the stock immediately and not have a capital gain.
Under the current laws.
Under the current laws, right. But again, this is likely to go away. So I'm not sure if you can do much planning here.
Right. But definitely something to know if this strategy has been talked about as part of your estate planning strategy.
Right.
Okay. Number 12, donor advised funds.
So when you think of a donor advised funds, they are created by companies like Vanguard or American Funds or Fidelity. And I am a donor. Let's say I give $25,000 to this donor advised fund, and I tell them how I want the money invested. And I tell them who I want distributions to go to and at what frequency. You don't have to make a distribution. Every 5 years or so, you should make at least one distribution to be qualified. But and in other words, you control, and as long as the fund company can verify that who you want to receive that money is a 501c3, they're going to send it out. They do all the administration. It's easy, no fuss, no muss. And you get the tax deduction for making that $25,000 contribution to the donor advised fund.
Okay, fantastic. Number 13, sell appreciated stock in lower income years. So this is a timing strategy.
Yeah, it sure is. And it's something you discuss with your advisor. Your advisor should be looking at your account and advising you on when they should know you and know when you have a lower income year, and looking at your portfolio and putting two and two together.
Now, again, to your point that you mentioned earlier in the episode, first and foremost, you need to make a good economic decision.
You always make good economic decisions.
So, okay. All right, number 14, exchange funds. So explain what exchange funds are, because they are different from exchange traded funds, ETFs, which we were talking about a few minutes ago.
So an exchange fund is a pool. It's a pool of stocks that Christina decided she didn't want anymore, and I have a highly appreciated stock because I worked at XYZ Corporation that I don't want anymore, and I want to diversify. And so we have hundreds and maybe even thousands of people that put their shares of their stock upon supervision and acceptance by the fund company into this pool, and then automatically I'm diversified. Christina becomes diversified, as do the other 100 people in this new pool of this new pooled fund. And it's wonderful because I can make that contribution and not pay capital gains. In fact, I won't pay capital gains until I sell my shares after a predetermined holding period.
And what's so great about this is, for a lot of individuals who do have a large holding of one stock or one investment, the capital gains that you would realize from diversifying can be one of the main roadblocks to diversifying from that position. And so this does take that obstacle away to a certain extent.
I think under the proposed Biden tax plan, these funds will become extremely popular in future years, because the long-term capital gains rate would likely go away for people who would have eligibility for an exchange fund.
Okay. Last but not least, and maybe one of the most important ones, adjust your game plan to updated tax laws. I mean, this is all the more relevant given, what's happening right now.
Correct. Make sure you're, you just exactly what you just said, Chris. And you should be, your advisor should be working with you to discuss what might be relevant to you, knowing your situation. And, we recommend having a meeting at least annually to talk about what's going on in your life, what's going on with taxes, what's going on with estate planning, so that any adjustments might be considered, discussed, and maybe even acted upon.
Absolutely. And like we were saying before, it is all intertwined. So if any of these strategies are of interest to you, or you think that they might make sense for you, talk with your advisor. You can give us a call, and most likely that conversation will include the rest of your team of professionals. If you have any questions, you can reach out to us, give us a call, or email us. Our contact information is at the bottom of the screen. And thank you all so much for joining. We will be back next month for another episode of Coffee with Bob. H&A's investment committee, a few members of our investment committee will be back for another quarterly market and economic update. H&A's Director of Investments, Bernard Carter, and Wealth Advisor, Bobby Hapanowitz, who also helped set up our investment committee. Later on in the year, we're actually going to have an episode dedicated to estate planning and some tax mitigation strategies that might make sense for you. So look out for that as well. And we'll see you next time. Thanks, everybody.